welcome to the NISM Masterclass. I am your host Sashi Krishnan. Our purpose at NISM is capacity building for the securities market ecosystem, and as part of that purpose, we sit down with the gurus of the securities market for a conversation to learn and understand from their journey. And my guest today is Vikram Kothari, and Vikram is the CEO and Managing Director of NSE Clearing Ltd. And Vikram has been the Managing Director of NSE Clearing Ltd for almost a decade now. And I think by far he is the most knowledgeable and experienced person in his field today. Welcome to this masterclass, Vikram.
Thank you, sir. It's an honor.
Vikram, let me start with a very basic question. What is the role of the clearing corporation in ensuring, financial and operational integrity in the settlement process? Because I think, the integrity of the system is actually the most important thing that the clearing corporation is tasked with.
Today, clearing corporations, they sit in the center of the entire capital market ecosystem.
Right.
They are recognized as a market infrastructure institution whose primary job is to ensure that all the trades that are done on the platforms of the exchanges are settled seamlessly to the buyer and the seller.
Right.
Like if I just try to elaborate it further, a buyer or a seller who's coming on the platform of the exchanges are anonymous order-driven systems. He does not know who his counterparty is.
Correct.
For all practical purposes, for every trade that happens on the platform of the exchange, the clearing corporation becomes the counterparty to the transaction.
Correct.
It is the clearing corporation's job to ensure that each and every transaction is settled in a timely manner and the way it is required to be, to the satisfaction of the buyer and the seller.
Correct.
Now, a lot of supporting infrastructure, the governance norms, etc. around it. So if you look at some of the key points which facilitates a clearing corporation to be able to do this role effectively, one is absolutely our regulatory framework prescribed by SEBI, the SEC norms. It provides a very deep governance structure onto how a clearing corporation stays independent, has arm's length distance from the members that it services or from the parent exchanges, and it is able to define policies, procedures which provide fair and equitable access to all.
Right.
Then comes the next layer, which is a robust risk management system, because that's again going to be the core of any settlement guarantee that happens out there. And today, the risk management framework of our country and the way it's defined for our markets is, I can maybe say that it's one of the best that exists globally. Today, the way we risk manage each and every trade, identifying each and every individual investor out there, managing the margins, the exposures, comparing it to the collaterals at each investor level, it does not get done anywhere in the world.
Right.
And we are talking about unique investors, or approximately 110 to 120 million unique investors who are registered to trade on the markets. Next comes, I think, the technology, which actually serves as the bedrock for maybe ensuring efficient processing, ensuring continuity of operations, and providing seamless and supporting innovations that we have been doing in the market, not only to maybe give confidence to the market space as to how we can do it more efficiently with a very fine risk-based comb out there. I think technology and a very resilient framework that exists for us today, with the kind of hardware backups, the DR sites, software backups when we work with the other competing clearing corporation as well to be able to use their softwares. So the framework is very well drawn out, very well defined, which actually allows a clearing corporation to do this role of giving confidence to a retail investor that yes, if he's traded today, his trades are going to get settled at the time of settlement.
So you raised some 2 or 3 very interesting points. The first point that you raised, and I think if you could just explain this in a little more detail, is that you are ultimately converting bilateral counterparty risk into a single counterparty risk towards yourself. That's, I think, the first thing that you said, which is how you guarantee the integrity of the system. So could you just explain a little more in detail about how this happens and the innovation process itself?
It's not a single layer approach.
Okay.
I like to generally call it a multi-layer approach.
Okay.
It starts with our regulatory framework, which actually requires upfront margining for the investors at the time of execution of trade.
Right.
And margin is nothing but a computed probability of loss, which is actually in case they fail to settle.
Right.
So that's what is collected at the time of execution of the trade. And it's not only collected by the clearing corporation from the clearing members or the trading members, our ecosystem requires that this margin actually gets collected from the investor itself by the members. So that's the first layer of protection. Second is the entire risk management systems that the clearing corporations apply. Today it's a trade by trade risk management. So when we are talking about almost what we settle around 100 million trades a day on an average across both F&O and cash. And we today risk manage trade by trade at each investor level. There's a very strong regulatory framework which allows us to identify the collateral of each investor through the entire journey that the collateral takes place, through either the collateral allocation that is required to be done by the members. That means that funds that they collect, they need to identify on the clearing corporation the entire collateral that is received by them, plus the entire securities pledge, repledge mechanism which allows. So that's the second layer where the robust risk management system which allows us to do client level risk monitoring. Plus also if we go to the third layer, I think the third layer is the technology framework that actually supports this entire thing.
So if I may ask you a question, Vikram, how do you assess for this counterparty risk at a individual investor level?
So sir, when we have the available collateral from identified against each single investor. So, okay, let me just come back. How does this framework work today? We are an upfront margin market. The investor is required to give collateral to the trading member, the executing member to whom is executing, and that collateral has to find its way to the clearing corporation. If it's in the form of funds, the funds are provided to the clearing corporation. The member is required to allocate that amount against each client of his. So it's notified against each client. Separately, if there are securities which are being provided as collateral by the member, the securities don't move through title transfer in our ecosystem anymore. In fact, SEBI moved to the pledge repledge mechanism, got the depositories to change the framework. The securities which are lying in the investor's demat account can now be pledged and repledged further to come to the clearing corporation, get earmarked against that specific investor. So we know what the total collateral pool of a particular investor is. Now every trade that the investor does on the platform of the exchanges flows real time to the clearing corporation. So on that, there's a margin requirement which is computed by the system through the algorithms and the mathematical models that we apply. That margin is mapped against the available collateral to determine whether the client, how much exposure a client can take. So that's the way we monitor. And more importantly, that's what allows us to ensure that every client is sufficiently collateralized to take his positions, and there's no undue leverage in the market which is being provided. That reduces the chances of default to a great extent.
So, what in case of certain negative externalities like collusion or market manipulation? Do all these guarantees and margins, collateralization, does it take care of all that?
Sir, what you talked about, the type of activities like collusion, etc. No. Margining system is to ensure that every trade out there, which is guaranteed by the clearing corporation, is settled and is effectively collateralized. These are certain functions, what you mentioned, which are separately looked at by the exchanges. They have a well laid out surveillance mechanism, surveillance departments, where they exchange information, they analyze information, and those are type of activities which they look at significantly. But yes, in case there's any information required for them to establish any facts of wrongdoing, the clearing corporations have a lot of host of information which we share with them time to time.
So you have something called a core settlement guarantee fund, right? And this is created and managed by the clearing and settlement entities. And in case a member defaults, could you just explain to us how the default handling mechanism then kicks in? And you have concepts like minimum required corpus of the settlement guarantee fund, and it's a fairly sort of robust but complex mechanism. So could you just explain to us how this works?
So before I come to the settlement guarantee fund, let's talk about default. Default is the second stage. First, it's got to be shortage, because when we are doing the settlement on a particular day, there's a possibility that a member has failed to deliver either the funds or the securities that has. So that's basically comes as a shortage. At a first level, there are effective mechanisms how to manage that shortage. So in case there's a short security delivery, there are mechanisms like identifying the shortage, going for an auction in the market.
Correct.
There are auction, if a shortage is there, there are penalties which are prescribed.
Right.
So there are various mechanisms first to try and address that as a shortage.
Right.
Now, in case there's a gap.
That's on the security side.
On the security side, even on the fund side.
On the
So
fund side.
there are margins which are available, collaterals
So you
which
can
are
draw on the
available.
margin.
We can draw on the margins, etc. And in case there's still a shortfall, then you're looking at a default scenario.
Right.
That's where the settlement guarantee fund kicks in. Now, I'll come to the settlement guarantee fund, how it's created, how it's measured later.
Right.
But more than that, the settlement guarantee procedure of utilization is a very well-defined, layered approach. It's a waterfall approach where at the first instance, it's the members' available capital, the trading member, the clearing member, who's facing off to the clearing corporation.
Right.
His available capital and collateral, then comes the balance sheet of the clearing corporation, then the guarantee fund.
Right.
So there are multiple layers, and it goes down right. It's a very detailed procedure as to how it will be operating the entire waterfall.
Correct.
Now, this settlement guarantee fund itself, the way it is created, you mentioned about the minimum required capital to be funded on that.
Right.
So it's a stress test methodology which is
Right.
prescribed by the regulations, and the formula, the methodology is very well prescribed. On a daily basis, stress tests are conducted on the overall positions that we are holding as a clearing corporation across the market.
Okay.
And there's a principle of cover 2 and cover 3. So technically, the way the guidelines define is that if you are a non-systematically important clearing corporation,
Right.
you have to cover for risk of the top 2 members of your defaulting, right? So that's, and for a systematically important clearing corporation, which NSE Clearing
Yeah,
is,
NSE Clearing.
we look at cover 3 for determining what is the kind of stress loss scenario in case say top 3 members were to default.
Okay.
And that requirement of fund has to be minimum covered.
Okay.
For a systematically important CC, the SEBI also prescribes a minimum threshold. So while your MRC by the stress loss computation mechanism, which is done on a daily basis, then it's assessed on a monthly basis. So
Right.
the computation gets revised every month of the overall corpus requirement. But whatever that number may come to, SEBI prescribes for a systematically important CC that minimum 10,500 crores needs to be maintained. So that's one side. Now, who contributes to this fund?
Correct.
That's one of the most important
So
aspects.
10,500 crores the minimum requirement of that corpus fund.
Yeah.
And then after you do your stress tests and come up with your MRC, you will have to keep topping up that fund.
And who tops that fund?
Right.
Who brings in that fund? So that's also
So
very.
before we get into who brings that fund, that corpus itself, where does that come from? Let us know.
Yeah, so that comes today, it is primarily contributed by the clearing corporation
Clearing corporation.
and the exchange, parent exchange. So
Right.
it's a layered approach. That's what I was coming to.
Right.
In the entire fund requirement, 50% has to be brought in by the clearing corporation itself out of its own capital.
Right.
Then the next 25% is the contribution by the exchanges.
Okay.
The last layer, which is defined by the regulations as a clearing member's contribution, but it's technically allowed to be contributed by the exchange. So in our case, some bit is contributed by NCL, but primarily it's contributed by National Stock Exchange, the last layer. So that's the way the entire fund
So it's
gets run.
25% from the clearing corporation,
50% from the
50%
clearing
from the
corporation,
25%
from both the exchanges in the ratio of the turnover that they have.
Right.
And the last 25% is some bit from the clearing corporation
And
and
some from the
parent
member.
exchange, which is National Stock Exchange in our
right.
case.
And how do the members contribute this? Depending on
Currently don't.
the volume of trades that
No,
they do?
currently there's no member contribution. So I think
There is no
this is, again, if you look at the global norms of SGF contribution,
Correct.
you will see that the concept of skin in the game.
Right.
So majority of the fund is generally contributed by the members.
Correct.
If you look at all the developed world, in fact, to the extent of 90%, it gets contributed by the members.
Okay.
Only 10% is the clearing corporations. Exchanges don't contribute to guarantee funds typically.
Right.
Unlike our case, where exchanges and clearing corporations are primarily contributing to the entire
Right.
corpus of the SGF.
So this clearing members not having skin in the game, is that a risk?
It is to a great extent because technically, if you don't have your skin in the game,
Right.
you are not going to be serious towards the risk management practices, the
Right.
default mechanisms. But yes, that is something that is
But you've got
evolving.
mechanisms to ensure that they...
We have other mechanisms to ensure that
Right.
it gets covered out.
So coming back, just taking a little diversion out here, settlement cycles in India have been shortening. So we've moved to T plus 2, then we moved to T plus 1, now on a selective basis we've gone to T plus 0. So how does the shorter settlement cycle, impact clearing corporations? I mean, one from the technology side also, but from a risk management perspective also.
So, first is that I think we should applaud our country, our regulators basically. We were the first one to actually make that move to a T plus 1 shortened settlement cycle. And the way we did it seamlessly by migrating 500 stocks every month across a 12-month period, I think was one of the, when it comes to technology, for that 1 year, we were required to maintain both settlement cycles on our platforms because we were settling securities on T plus 2 and we were settling securities on T plus 1. But all said and done, it was a very smooth migration technologically where the exchanges, the clearing corporations and the depositories all came together to put up a process. Now, when it comes to how does it affect technology? Say you're used to a 48-hour settlement cycle because you trade today on a T plus 2 settlement cycle, you're settling the next day at 11 o'clock. And you are technically moving back 24 hours, which is cutting the cycle out to 50% of what it originally was. Now, it's not only about our technology, there are a lot of market processes which have evolved, which are established around a T plus 2 settlement because you're not only looking at one set of investors, which may be retail in India. Retail in India was a big facilitating factor for us, given that it was upfront margining. Most of them were anyway trying to settle to avoid cost of margining, were already trying to settle on T plus 0 with the early pay-in mechanism, etc. So that was one which was a big facilitator. But when you look at foreign investors, you've got a chain of intermediaries involved. You've got an investment manager, you've got a global custodian, you've got a local custodian, there are banks, there are different FX zones, geographical distribution parties. I think that alignment was the more important part. From a technology perspective, what was important was that we had to relook. Our technology is a proprietary technology that we use today, fairly very agile. In fact, we've realized the kind of changes that have happened in the ecosystem over the last 4 years. The technology has supported us. We have been able to modernize it. We have been able to innovate and look at it differently on multiple occasions. We had to look at how we can decouple the processes out because if you have to cut down almost 50% of your processing time, while you have to look at external timelines, you also had to look at your internal capabilities to see how your technology is coupled at many stages, has dependencies on some processes prior to next processes getting done. Can those processes be brought in parallel? Can that decoupling be done? Can those dependencies be taken out? So I think our technology teams stood up, they raised their hands and they said, we will relook at the processes. And so believe me, at one point of time, we were running same platform, T plus 2 settlement and T plus 1 simultaneously. But effectively what this entire mechanism did was, it allowed us the time to test our T plus 1 systems over a period of 1 year. As and when securities kept getting introduced, the volumes started slowly increasing. And so it allowed us to slowly keep testing our tech. And I should say on the first day itself, when we went with T plus 1 parallel with T plus 2, our T plus 1 worked seamlessly and not only across clearing corporation, across the depositories, across the exchanges. So I think, yes, technology was one of the key requirements. Second thing was about how these processes across intermediaries, there is global custodians, the banks, the local custodians, etc., how it gets aligned to fit and cut that 24 hours out of the entire cycle. And given that we had a phased approach, everybody in the ecosystem got enough time to actually build their systems, test their systems out, and get integrated into it seamlessly.
What about on the risk side?
So on the risk side, yes, it's a common knowledge. Holding a position for 2 days versus holding a position for 1 day, the risk is going to get cut off. In fact, we have done our own in-house researcher has done a paper on the impact of movement from T plus 2 to T plus 1. And he's used empirical evidence as we kept migrating, how the liquidity was getting impacted. And we saw that there was a huge amount of liquidity freed up because of the margins coming down in the ecosystem. And what we also saw is that liquidity was actually getting invested into securities in the next year. So that was in fact good liquidity getting freed up and coming and providing liquidity in the stocks which were otherwise sort of illiquid.
Right. So from a clearing and settlement process, there is a huge amount of risk that gets eliminated as
Absolutely.
you get into shorter trading cycles.
Yeah.
I just wanted to also ask you to throw some light on the interoperability of the clearing corporation, because while it increases the market participants' access to the financial markets, and it is also fairly cost effective to the market participants, it could also at some point of time bring in some element of credit risk that you have against other CCPs. So could you just give us a sense as to how interoperability works, and how does it benefit the investors, and what are the risks it is to the clearing corporation itself?
Sir, while we talk about shortening of settlement cycle, interoperability and many other things, I think we as a country can take pride in many of the kind of firsts that we have done over the last few years.
Right.
In fact, interoperability certainly was one of the first such innovative project where what we were doing was that we were allowing an investor to actually giving him a capability to trade across multiple venues while having the benefits of netting and consolidated capital at one clearing corporation. Mm-hmm. Earlier, the ecosystem was where a parent exchange where the trades used to happen, the subsidiary clearing corporation used to clear those trades. Yeah. And similarly, there was another exchange where the trades used to happen, investor used to clear and settle at that point. There were islands. If he had to trade product at one exchange, he had to keep his capital at another exchange. He had to trade the other exchange, the capital had to be kept at other exchange.
Also, he had to keep capital at
both exchanges, both the clearing corporations. So while interoperability achieved many things, two of the key things that it achieved was it allowed far more efficient utilization of collateral, because with interoperability, what we did was we actually had every clearing corporation talking to every exchange. That means while NCL could clear always the trades of NSE, now NCL can clear real time with that same latency, with that same speed, all the trades that getting done at BSE as well, or a Metropolitan Stock Exchange as well. So the client was required to have his capital only at one clearing corporation. Right. The second benefit that it did was it allowed netting benefits across multiple products. Right. Now he could trade a security in NSE, he could take an offsetting position in the BSE, and the position would get netted off. Okay. Technically, better utilization of capital. He did not have to settle two positions. He only has to settle one position.
Both the clearing corporations are talking to one another.
Not necessarily. That's a separate bit. Right. That happens where the counterparty. So coming first to the netting benefit. Right. Now, sir, how does this work? It is possible that a trade is happening at one exchange, and say one investor's broker is clearing through NSE Clearing.
Right.
The seller's clearing corporation is the other clearing corporation.
Right.
In that case, the clearing corporations need to talk to each other. Right. Because there's a counterparty settlement which is going to happen between two CCs. The seller is going to deliver at the other CC. Right. The buyer has to receive it at this NCL. Right. So now there's an exposure which gets created between the two clearing corporations. That exposure is called inter-CC exposure, inter-clearing corporation exposure. Correct. I'll come to the settlement process later and how it works in case of an interoperable framework, but from this risk perspective, there's an effective mechanism of collateralization between the two clearing corporations as well. Okay. So we identify risk on a regular basis as to what is the risk of non-settlement in case there is in between the two clearing corporations, and that is effectively collateralized between both the CCs to cover that risk out. Now, how does the settlement work in case there's the example that we took, somebody who's clearing through another clearing corporation and somebody who's clearing...
Another broker and doing a sell trade, and here you have another broker and doing a buy trade on another exchange.
So in that case, a clearing corporation, when you look at the settlement process, it has always got to be a sum zero. Right. Whatever you receive is whatever you have to give out. Right. Let it be securities or let it be funds. Earlier it was very simple because it was your members, you were receiving and you were distributing. Correct. Now it's about receiving from your members, the other clearing corporation is receiving from its members, right. The pay-ins have to happen. Yeah. Subsequently, there's something that this clearing, NCL needs to deliver to the other clearing corporation. Right. There's something that the other clearing corporation needs to deliver to NCL. Right. So once the pay-in process, that is receiving of the funds or the securities from the market is completed, we assess the difference that has to be settled between the two of us. Right. We do that settlement bilaterally
Right.
through an intermediary. We have a third party independent intermediary in between us.
Okay.
We complete that settlement, and that's when the final. So, whatever we can release to the market immediately within our own pool, we do that. Residual, which is very small difference, which gets settled between the two, separately gets settled. So, it's a very well oiled, a very well defined process. And the intermediaries, let it be depositories, clearing corporations, work very efficiently together on this entire process of getting the settlements done. It's a seamless process today.
So there's also quite a bit of technology, I suspect.
It is. It's completely a technology-driven thing. We have our pipes with the other clearing corporations. We have our pipes with the depositories. And earlier it used to be a very single mode kind of a communication that used to happen. But now the communication has dependencies at every leg. You have to get one leg over to start the other leg. The other leg will have a dependency on the third leg. So it's a very, what interoperability has done is that it's got about a lot of integrity in the ecosystem. So technology has not only assisted a particular CC or a particular exchange. In fact, this innovation of interoperability has brought up the technology capabilities across the entire ecosystem, including the banks, the depositories, the clearing corporations, and the exchanges.
The other question I had was that given that there is leverage and volatility in the derivatives market, do you need to put any additional safeguards to manage risk in the derivative segment? Are there any additional margining requirements? Are there any real-time margining requirements?
So, to be very honest, the risk management framework that has been outlined by the regulator for the country is fairly a very sturdy model by itself. Right. If we look at all the kind of risks that we've seen over the last, I would not even like to take a bet on 1 decade. Right. In fact, you go down 2 decades or 3 decades, there have been various global events, there have been various local events which have happened in the ecosystem. And our risk management framework has taken care of all those anomalies like a shock absorber. So it's technically we've been very safe, we've been very smooth. The market has, and I think some of the developments that have happened in the recent past, like upfront margining, entire collateral collection from the client, I think it's smoothened out the entire process to a great extent. That said, so SEBI prescribes the minimum risk management framework, which the regulator prescribes the minimum risk management framework, which has to be established across the ecosystem. Right. But that's the minimum. Right. We have our own models which we run on a continuous basis to assess any additional risk, maybe of concentration, maybe of liquidity, which we observe. We have complete freedom to actually cover that risk out with additional margining. So that is completely allowed. Right. And we do that on an ongoing basis. While it's not public knowledge, but we do our own models, we do assess risk, we identify concentrations. There are SEBI prescribed norms around how much of positions can be held by a particular category of investor, by a broker, etc. Those all come in handy. So there are measures which go beyond the traditional risk management system, which are applied by all the clearing corporations from time to time, sir.
But specific to derivatives, is there something that...
Specifically, so while it's something that we do, it depends upon the kind of observation that we have. It can vary, but it can be something like additional concentration margins, collection of additional collateral, collection of mark-to-markets in advance rather than waiting for the next settlement day. Right. Depending upon how the situation is, what the volatility in the market is, what the positions of a particular member or an investor are, we do take our own risk management measures which go beyond the minimum prescribed from time to time.
You've been introducing a number of, let us say, features that empower investors in this market, providing greater security, transparency, efficiency. So, for example, you have this direct payout of securities.
Oh, yeah.
And then you have, this blocking of funds facilities.
Yeah.
And I think you are in the process of introducing many such things. So, could you just tell us how does this sort of benefit investors, these features that you have introduced?
Absolutely. I would like to just go back to the earlier process of settlement.
Okay.
Earlier, when the securities used to get settled, so before that, let me just jump a little back.
Sure.
One of the key things in a market which has brought about a lot of safeguard is that today, every day when a trading gets completed, we have the obligations available with the clearing corporation. Right. And those obligations are shared with the depositories. The first step was that in case a member wants to move securities from his pool to anybody else or outside the normal course of settlement, depositories don't allow it, because now they are privy to the information of what the obligations for the next day's settlement are. So I think with that,
that's because of real-time flow of information.
yeah, so because every day when the trades happen, the clearing corporations have the obligations available immediately after the market closes. Earlier we used to sit with the obligation, now we share it with the depository. It allows depositories to then manage and make sure that the securities only move in the ecosystem for the purpose of settlement to the extent that they are required to. They are able to ensure that. With that step done, the next was that we still used to settle the securities back to the broker pool account. Now brokers ideally always used to settle it back to the investors. But there was a thought that broker is just acting as an intermediary in between, and he's receiving the shares, he's settling to the investor. Why don't we settle it to the investor directly? Technology allows us to do that. It provides us the capability to do that. And that's where and plus it becomes a more safer ecosystem, because even if there's that one bad actor out there who wants to play around with the securities, he loses the opportunity to do so. And technology allows us to build that framework where we can deliver securities directly rather than delivering it at a member level, directly to the investor level. So that's what direct payout mechanism is, and that's been implemented and it's working very, very well.
And that's de-risked the system.
That's de-risked the system to a great extent.
And what was this blocking of funds?
So this blocking of funds always existed in the IPO space. What was called ASBA model, where when you were applying for an IPO, you could have your funds blocked in your bank account. It did not move to the RT agent or the bank or the company, and you could pretty much retain your funds, and only to the extent of what you used to get allotments is what used to get pulled out of your bank account. So that was already existing in the IPO space. So this was again one thought, again with regulator on the drawing table, and the thought was, can this be brought into the secondary markets, where today an investor technically has to pass on with his funds to the broker, and those funds today have to come to the clearing corporation as earmarked funds, but they can be in a form of other collateral. But what if the funds stay in the bank of the investor, stay blocked over there, and still give him the capability to use that as collateral to be able to trade? So that's where UPI system was integrated. In fact, while it is still to be offered by the brokers to the market, but from a clearing corporation and ecosystem perspective, it's very much available.
You're ready to offer that.
The investor can retain the balances in his bank account, and through the UPI framework, he can earmark it to the favor of the clearing corporation through the broker's interface. And the clearing corporation has the capability to provide the investor that available exposure on that collateral. And in fact, those funds can also be used from a settlement perspective. The funds did not move across the ecosystem. Yes.
So I had a question on new asset classes. I know worldwide we are seeing a lot of new asset classes like tokens and cryptos and digital assets, etc. So what are your thoughts on those kind of assets, and what would be the role of clearing corporations once those assets actually come into the Indian ecosystem? I know they are there in the Indian ecosystem, but at some point of time, I presume a couple of years down the line, they will be there.
Yeah. So in fact, multiple products do keep getting evaluated with the regulators. In fact, we just saw one of the commodity exchanges getting permission for electricity derivatives in the country, right? So various products, we keep an eye on various products which are there out there. We keep the same keeps getting discussed with regulators from time to time by the exchanges, because it's the exchanges which actually look at these products on their platform. And we work very closely with them from a facilitation perspective, how the settlements will work, how the risk management will work, what will be the kind of risk management norms that should evolve with these products. But yes, we do keep an eye on what is also happening globally. We are aware about the tokenization, the wave of tokenizations, the wave of digital assets. In fact, there are huge funds which are only getting launched on the back of digital assets globally today. We keep a watch on them. I think when the ecosystem permits and the regulatory framework is conducive and open to looking at, because these are assets which need a lot of understanding. There are risk management measures which need to be well understood, settlement mechanisms which need to be well understood. I think over a period of time, when say the regulations evolve towards these products as well, we'll be very well geared to actually provide
So
facilitation
in
for
many of these
that.
assets, the settlement will be through a blockchain mechanism where it
Can
will
be,
be
sir.
a ledger entry.
Absolutely, can be. So I think we have to understand how it gets done in our ecosystem.
Right.
We'll be geared and ready to facilitate whenever these type of products get discussed in our ecosystem.
You know, the one of the products that hasn't sort of taken off in a very big way is the securities and lending securities lending and borrowing, the SLB market. It's still around a 38,000 crores market. It's growing, no doubt, but maybe not as big as how it is, in the global market. So, what are your views on, this market, and how do you think it will grow as we go ahead?
So as you said, we have started seeing growing amount of interest in that space, and the market is now picking up. Now, I'll just like to draw a parallel to how the global markets work on securities lending and borrowing.
Right.
They are primarily bilateral markets.
Right.
We are an exchange-driven market, an anonymous market again, and our requirements of the market for using SLB are primarily around either people are getting into strategies which require them to short the cash market and borrow, or primarily also in case of shortage, in case they face and they need to borrow to actually deliver in the normal market.
Right.
So I think these are the key drivers where some of them are using strategies, some of them actively use SLB as a product profile matched with their futures and options trades on arbitrage, etc. So they are doing a lot of reverse cash carry arbitrage, etc. Globally, there are other factors which also drive the SLB market to a great extent. It can be something like dividend tax arbitrages, where people do use borrowed positions to actually take benefits of dividend tax benefits, etc.
Right.
But being bilateral, there are big banks which actually facilitate these trades. They have active securities lending desks which do that.
Right.
So in our market, it's not yet a segment, so we offer it as an intermediary, authorized intermediary,
Right.
and everybody comes to it as a participant. So yes, it is picking up. We are also in constant discussions when we meet participants. We talk to them about what can be done further to actually deepen liquidity in this market. There are suggestions which are received, which we continue to work on. Regulators do invite suggestions from time to time, because I think regulators also appreciate that a deep securities lending borrowing market can end up providing that cushion in case of and support to the normal equity and the F&O markets.
Right.
So there's a lot of feedback and tweaking that gets discussed from time to time. Let's see how this goes forward, sir.
I want to come back to something that you have very often talked about, very close to your heart, and that's about technology. And I thought I'd get a sense from you as to the intensity of the technology that is needed in building out this entire ecosystem. Today, as you pointed out, you are settling close to around 10 crore trades a day.
Yeah.
And at the peak, you had settled something like 30 crore trades a day at some point of time. And obviously, all this requires low latency and high availability of infrastructure. And therefore, infrastructure becomes very key to the entire, clearing and settlement process. So, how do clearing corporations use technology to manage the scale and the efficiency of the entire system?
So when it comes to managing the existing technology, I think the important part is it needs to be agile enough to be tweaked to requirements, capability of scalability of the ecosystem,
Right.
and high availability, because we cannot talk about a 99% downtime or a 99.9% downtime.
Right.
MII has to be available 100% out, right? So, and plus the kind of changes and innovations that have happened in our ecosystem, some of them first in the world, can only happen if you've got a technology which is capable of getting upgraded from time to time with respect to the requirements, as well as important is scalability to cater to requirements of volumes. Right. So that has been a very big bedrock for the clearing corporation's ecosystem. Second part is about availability and resiliency. Traditionally, people generally look at a DR site more as a hardware resiliency kind of a facilitation. So we have gone beyond that. So where we have a hardware, we have a DR site which is based in a different seismic zone as compared to our primary data center, which is here in Mumbai.
Right.
We have a DR site based in Chennai. And apart from that, what we've also done is we've gone for a software resiliency, where it was a regulatory driven project where now we can actually host a clearing corporation's risk management system out of the software of the other clearing corporation in the country.
Okay.
So, and we can do it both sides. So they can
they
can also switch over to NCL, we can switch over to ICCL.
Okay.
So we build that resiliency. The idea is more than settlement processes, the low latency and real-time availability is around risk management system.
Right.
The thought process is that trading cannot happen if there's no, we are a real-time risk managed market.
Correct.
And the thought process is that the trading should not happen if there's no risk management around it. Because all your controls are based around the risk management framework today. So high availability of risk management on a real-time basis is very important. So while we have this DR site, we also now have a risk management software resiliency out of the other clearing corporation. Right. Separately, sir, we all are aware about the cyber risks that are evolving. I think it needs to be talked about much more, and that's the real risk, an unknown risk, in what form, in what time it will come and hit you. I think that's where a lot of preparedness and planning needs to go, and it is going. In fact, the clearing corporations are recognized as critical infrastructure institutions from that perspective. And while we have various parametric solutions to counter these risks, we also are looking at a sort of a vaulted clean room kind of facility where which we've already created now.
So could you just explain what that means?
So that is basically a separate setup where the data is stored on a regular basis, right, and which is cut off from the overall network. Okay. And the data can be drawn in case of a requirement. And it's supposed to be a clean room where the data, once it goes in, it's already pre-scanned for any malware, etc. Okay. And it's stored in a vault kind of a situation. Right. So that is something that we are working on correctly. I think we already put up the infrastructure in place. Data is out there.
So in case of a cyber attack which compromises your system, you could pull out that data from
we are trying to create a capability to be able to pull out that data, right, and be least affected. Because in case the cyber issue, right, is a grave one, it can lead to number of days before which a, right, resolution can happen. Yeah, we are just trying to see how we can shorten that impact out, okay, and bring that gap down. So I think that's another area of technology where we are working and investing in a big way. I think we need to ensure that, see, today's ecosystem is a lot more about the framework and the technology, the bed that you work on, right, rather than people. It's slowly becoming a very technology-driven, right, organization. So, right, that's a focus area for us.
Wonderful. That was a very fascinating conversation, Vikram. Thank you so much for your time.
Thank you very much, sir. It was literally a great conversation for me as well. And thank you for having me here. Thank you very much.